When you have a crisis in confidence, you get a decrease in people's willingness to buy stocks in bonds and so forth and so on. So there's a massive decrease in the value of stocks and bonds. Most 401ks or retirement plans are in this kind of paper. Now, this may be a shock to people, but the stock market is run on emotion. It's not run on true economic fundamentals. It's not. And so the stock market can be controlled by the press, which it was, and so it crashed. There has been a bounce back. I mean, the stock market went from 14,100 and something down to, I think it got as low as, I don't know, 67, 6,800 if memory serves me right. And it's retrenched a bunch of that. The stock market is currently trading at about 11,000. People need to understand, however, that these are bets. You have your money in the stock market. It's a bet, and it is subject to the whims of the press. It is subject to what goes on in government. People don't have control of their stocks. They just don't. It doesn't mean that there isn't some individual stock out there that might be good. I'm not saying that. What I am saying is that the equities markets are controlled. The equities markets are subject to this kind of fiscal irresponsibility. They are the effect of that. And if I'm a person that's getting ready to retire, and I've got a bunch of money in my 401k, and it got wiped out, but now it's coming back, and I'm kind of hoping that it's going to be okay. Understand that you're not in control here. I'm not a fan of the equities markets. I'm just not a fan of them. And if you've got bonds, interest rates have nowhere to go. Interest rates are at zero. They can't get any lower than they are. So if you have bonds get less valuable as interest rates go up. If you have municipal bonds, for instance, if I sell you a bond that's going to pay 10%, which is not happening these days, but let's just for round figures. So you have a bond now that's worth 10%, that's paying 10% interest. Now let's say interest rates go to 15%. For you to now sell that bond, you're going to have to discount the principal of the bond because the potential buyer can go somewhere else and get 15%. So why should I buy your 10% bond? I'll buy your 10% bond if you discount the principal so that it matches the 15%. So that's the example. Those rates are not in existence currently, but that theory is applicable. So as rates go up, bonds become less valuable. And a lot of retirement accounts are in municipal bonds and so forth and so on. And I do not, just as a personal opinion, I don't have a crystal ball here, but if you look at what the government is doing, how rates have to go up, the logical conclusion is the bonds are going to suffer. Politically, it's very important for people to be aware of what's occurred here. And in fact, what has occurred is that the fiscal autonomy of the United States government has been dished off to a group of bankers in Basel, Switzerland. While that may sound conspiratorial, in fact, that's exactly what has occurred. The book makes that clear. You don't have to rely on the book. You can go to the website, to the Bank for International Settlements, or the Financial Stability Board, and you can research these things. So this is what's occurred. What is truly unfortunate is that the members of Congress have no idea about this at all. I have spoken to members of Congress. They have no idea. So what has happened is that the president signed an agreement in London in April of 2009, which should be, if it's not a treaty, then the next step down is it would require a congressional agreement. I think it's called an executive congressional agreement. The point is that Congress needs to authorize this. The president just can't be running around the planet obligating American citizens and taxpayers to situations where there's no congressional approval. That's why the Constitution says the Senate needs to approve treaties. And as I say, if this falls below the level of a treaty, and I'm not a constitutional attorney, but it's right in that range, then it would be an executive congressional agreement. So the bottom line is people need to make their elected representatives aware, one, that this happened, two, that they need to be responsible for what's occurred here, because it's really their hat, to use that term. It's their hat. They need to, one, approve this, but a very, very important caveat is not just approve it, but to approve it in such a way that it places elected officials, both from the United States and countries around the world, over these bankers, these international bankers, so there are checks and balances, and there's oversight over these people. We cannot let these international bankers run rampant without Republican representative oversight. Now, I use Republican not in a partisan sense there, but in the government sense of elected officials overseeing these people. So what needs to be done is our elected officials need to be hammered with communication to let them know this has occurred. They can educate themselves from the book and find out exactly what's occurred and demand that there be oversight over these international bankers. Extremely important. Secondarily, from a political perspective, and while this may sound like a reach, it is the only sound solution. And that is this, that monetary systems should be based on production. Money should represent products. There's a lot of talk these days that money should be backed by gold. Gold is certainly better than fiat currencies, which is what we have now. We have currencies that are backed by nothing other than government fiat, an order, a mandate is what a fiat is. But gold is fine, it's a step up, but here's the problem with gold. One, the price of gold can be manipulated. Two, there isn't enough gold to back the money on the planet. So what do? If in fact we tied money to products and real estate, you couldn't inflate it. You couldn't deflate it, which is what's causing these financial crises. The amount of money in existence would be such that it could buy the products that were available. And the more productive a country was, the more money there would be. You could have an annual survey, and yes, this would take a little bit, but an annual survey, what's the GDP of that country? What's the gross domestic products of that country? And then the bank issue or ensure that the amount of money in circulation represented the production. And that's a very important principle that needs to get in if we're ever going to stop these this roller coaster ride in the economy. So those are the political solutions. Get control over these international bankers and put a monetary system in place based on money representing products.